It's not an entertainment production. We don't make jokes. We just watch what the Fed is doing and giving an account of what really is on their minds. So you may take our production as it is. If you find it's cabaret, that's fine. That's how the reality looks like. So in today's Blockrevisions episode, we are starting at 2:45 p.m. New York's time, as every day. However, yesterday was Polish holiday, that's why it was in a different manner. But today we are getting back to previous editions of that has been published before. So today I will show you the most important facts regarding the stock market, the cryptocurrency, and commodities, as well as we will end up with earnings season and economic calendar, as well as trade ideas. So let's get started. So at first we are just heading into an economy view, and we are starting with an interesting chart where we can find that right now we are at consensus, where among those survey that we will have 50% chance to get a recession, where we have found that recently those measures has been even priced to this levels of 80%, and that's why I think there is still a room to grow for this measure. However, right now we can find that even if this gauge has been a little bit outstanding, that hasn't really coincided with 100% certainty that this recession may come over. Whether 2020 was a recession time, that still may be debatable, but there was definitely an abnormal situation for the economy that might be considered as such. Builder sentiment sagging right now. We can find that that's one of the very important gauges, because it's of the leading indicators, and this leading indicator for Fed should indicate that those decoupling between houses prices and also the amount of transactions on the market right now is pointing that may get a little bit broader, as builder sentiment is at this low levels below 50ish that was recently been seen, with this slump resembles that one of 2007, and finds we may have a little bit more hard time on market, housing market, that may cheer many investors that are just awaiting and just anticipating some housing market bargains. So right now builder confidence is tumbling, as high mortgage rates exacerbate affordability challenges for houses. And right now we have found that on top of elevated costs of materials and labor, there was the problems among which those indicators has slumped that much. So tighter monetary policy from the Federal Reserve, and also this elevated construction costs I've mentioned, were those that may bring eventually a housing recession. When will it happen? We could find it recently such scenario where we had seen such a tumble was recently in 2007 and lasted throughout few months, and afterwards we had a a massive slump on a housing market in next few months. Will it happen this time? That's also very interesting. However, uncertainty index for United States right now, after recovered and got back to those low levels, whether it's considering monetary policy or the common one, common one, are right now at the levels that have recently been noted back before this corona crisis, but right now, unfortunately for Fed, and this one is heading back to north. So due to these problems, we may find that there was Russian invasion of Ukraine, fiscal stimulus-driven rise in consumer demand, but right now we are reverting the curve, and that might be of concern for the government. This stems to the real anxiety that whether we are able to substantially bring this inflation back under control in a timely fashion. So, for the market, CBOE 10-year Treasury right now is discounting the scenario where we may get through this elevated inflation period a bit longer. Market is not trusting so much the Fed that they will be able to get it at the satisfactory level to have an economy move in a right direction. In this time, we are reverting this head and shoulders pattern that are indicator of a possible bulls returning to the this index. And with this one, US junk bond spreads have fallen back from recent highs, and that gets us down to the such conclusion that recently that we have gone through a lack of demand before the rebound in this market. That's why we have found that there was a kind of a much of a broadened interest of investors that they were able to receive for holding high yield bonds. So right now we are just selling off this, I would say maybe speculative rally, and heading back to around 4 percentage points. So for 10 axis, the amount of bonds trading with a spread of 10 percentage points or above a sign that the market may be distressed, and also that expecting the Fed will have difficulties ahead. So what it takes to fight a recession, because the one thing is this rate cuts. However, another one scenario is rate cuts plus forward guidance and asset purchases. So that will be a scenario where we will mix together quantitative tightening with a quantitative easing afterwards, and there is another scenario of strengthened automatic stabilizers. However, for the market, I would say that if you're expecting a dovish pivot from Fed with softer than expected rise in consumer prices, those will be certainly good, and that will come down to that rate cuts will be sufficient for this recovery. However, if you are just believing that corporate earnings will go down and interest rates will come down eventually, that will be a little bit less favoring scenario where we may find that Fed may revert back into forward guidance and asset purchases instead. So it's probably not going to be an easy path. Right now, lots of the returns are kind of under the question mark, and that's why there is so much uncertainty on the market yet. In terms of China, however, they are in an even bigger trouble. We can find that due to this chart, China retail sales recently throughout all those years since 2013, after 2018, this retail sales started to curve into a negativity, and also those growth may get a little bit diminished. So China is slowing down regardless of what they are just showing up at their reports. Retail sales are one of the biggest factors of a GDP growth for the country. Another problem is ratio of workers to dependents for China, and this one is expected to just have peaked, about to get peaked, and with this it gets down to the demographics for China is something that is not putting the government in a lucrative position. On the other hand, right now, China is really learning the hard way that leveraging the real estate market in the biggest real estate market in the world is bringing possibly very negative consequences for growth, and also it gets down to a situation where those citizens don't want to pay down their debts, as they already in the very, very problematic situation. So right now, private debt to GDP has reached the levels of Japan in 1990. That's why this crisis might be still ahead. So many of us are expecting China to accelerate the growth even further, but those problems are really enlarging with the time to come. Right now, there is a projection that top 10 countries worldwide projected to have the highest GDP in 2050 is as here, but the problems that right now flocking Chinese economy may have this projection disturbed. So right now we can find that more and more funds in the US are just flowing into bonds, and that's the reversal that I have mentioned. So we can find that the biggest interest right now is in an investment grade corporate bonds. That was about the junk that I have just shown up to you, and another one is high yield corporate bonds. So there is a bit more turn into a risk on bonds. This one showing that we are expecting a possible rebound on the markets. Weekly S&P 500 US fund flows showing that we are just past the worst possibly. With this V-shaped recovery, we may have another flow of inflow to those major markets. So may US decouple from China, and eventually may lead to the scenario where those countries will lead their way separately. I do think so, but that will be also the one of the factors that also may put China into trouble. Reducing United States' reliance on fragile supply chains from China can help insulate the economy from future disruptions like those seen over the last 2 years, and most often those decoupling make strong stronger and weak weaker. So ending up this stance, we can find that with US still entails more investors' money than China, and that shouldn't be switched anytime very soon. In terms of markets, we are right now heading into a market outlook. With this one, we can find that fear and greed index right now is crossing through neutral and slowly heading into a greed, and that's why I really just trying to persuade that the cautious is the biggest factor on those areas. Right now we are trying to pivot all of this bearish momentum that has been gained since beginning of January, and with extreme greeds on some markets such as stock price strength, or other aspects such as put and call options. Right now the much of the cautious is kinda highly desirable. So in terms of biggest markets, there's definitely a very interesting DXY chart that's right now showing a kind of a outlying strength. That means we are trying to get over this recent lows, these recent highs that has been built in this recession movement, and with this one to get through on a decent pace. Right after this sell-off, we may see another rally forward, and there's supposed to be kind of a cap with this handle already being formed. It's kind of a resemblance for this to this formation. So I would expect DXY to still move forward with an expectation of maybe a little bit weaker major US indexes for this week, and afterwards a possible this aggressive attack on 109 peak. So going forward, there is still a fierce debate whether we are right over this bear market. Druckenmiller sold big tech, as we remember, right at the bottom of this recent correction at around 20% from peak, whereas George Soros fund that represents of about 4.6 billion US equities portfolio has bought recently and virtually from Mr. Druckenmiller those stocks as Alphabet or Amazon. So we can find that some of the gurus are buying. Also Warren Buffett slowly and gradually is trying to broaden up his portfolio by boosting some sizes of tech positions, and not only tech but also some of them are just energy positions, energy stocks positions. So we may find that those corrections have winners and losers. Among those that are winners might be also that investors that recently been losers and in reverse. So that's why this world of investments is so I would say interesting in some cases, and also kind of strange for some. Right, so FMS investors are long cash, however short equities. That's why that's the scenario that resembles those COVID-19, but in the 2020 time, where we have found that much of the investors were piling cash during this 30% drop on US indexes. Right now we can find that this dissipation between cash and equities right now is favoring bulls that are most often in favor of heading into the path that has that is not really guided by a majority of market participants. And that's also very interesting. Market breadth right now is showing that 88% stocks of S&P 500 is above their 50-day moving average. So with this rally that has been a kind of combination of higher odds of stronger economic growth ahead, combined with a gamma squeeze and leveraging of those volume targeting funds, right now is showing that this rally is even a bit more persistent than it's supposed to be, as we can find with this economic, I would say, difficulties we are heading through right now. But it's not in a very rare case where we have a weak economy and a very strong market. That was right 1 year ago. So the only bear market, as I would like to summarize the very interesting statistics, the only bear market rallies in the last 7 decades stronger than the rise of the last 2 months, were increases of around 19, 21, 20 respectively persons, and that was during 2000 and 2000 year during the downturn, and 24.2% upturn near the tail end of the 2007 and 2009 cycle. That's why this recent period is represented with one of the strongest starts of new bull market if it eventually happen. And that's the visualization of why you shouldn't really skip those difficult moments for the market, because those days that are about to bring this a little bit more bearish performance might right after become the best days, and there's the futility of timing the stock market at that right now you may found. So those who claim they have avoided the worst days will probably omit that they missed the best ones. Those who try to time the market right now can easily jeopardize the long-term performance simply by being out of the market. So what I found very, very useful is that diversify your portfolio to this that is really focused on the short-term speculation, and this that is focused on a long-term prospect. And summarizing right now, whether we are in a kind of the time right before recession or not, the comparison of USA and median 46 countries showing that US is kind of expensive right now, and those differences may get kind of a may turn in the future as it was back right after this bubble in 2000, where after there was the time of emerging markets, and that might be also some of the indicator if the history is a teacher, that another cycle may really be more lucrative for those emerging smaller markets. In terms of trading economics, on Friday, I would like to head back to previous week for a while. We had right back then on Friday Michigan consumer sentiment, and that one has dropped, but still so it's getting better, but still we are at around 50-ish low area. That's why I do find that the recovery may eventually happen, but we still need some justification in terms of this inflation going down eventually. So University of Michigan showing that we are at the still lingering around those lowest levels since ever that rating been constructed, and right now we are touching from the low at those 1970s, 80s period of a high inflation. So let's move back to this week, as I haven't really touched it. So ZTW economic sentiment from Euro area is showing that right now we are still hanging around those minus 50-ish levels that are one of the lowest ever been registered. Previously, during this Euro crisis and also a GFC, we have had those levels only a bit lower. In terms of inflation rate for Canada, this shown that it was as expected, and right now is lowering from 8.1%. So the whole America is in a more cheerful moods out of this. We are still awaiting housing starts and industrial production. We already went through housing starts. That right now showing that we are heading lower. That's why the housing market may get eventually into trouble. And tomorrow we'll have a GDP growth rate out of the Euro area and FOMC minutes that should make an inclination of what May September's meeting bring to us. So let's right now jump to earnings season, and the Walmart has already published, and those data is really outlying projections, and that's why price change is showing a positive momentum. Home Depot also showing that they are not really scared of the current situation, and with this consumer spending still on a high level, we shouldn't be afraid of recession, at least to the severe recession, at least for now. And right now let's get to trade idea section, and that's for today will be a gold. So we are jumping to XAU to USD, and right here we can find that we have built a rising wedge that were coming down to a quick sell-off of around 18,000. So as I've mentioned in one of the previous episodes, those 18,000s become a resistance, and that was a very much of a likelihood that will be rejected out of this time. So gold and the dollar tend to have an inverse relationship, meaning the prices move in different directions. With Dixie right now rising, gold is selling off. That's why I do expect that right after correction, right after rebound, as we can find, we are trying to gain a revert momentum and rebound out of this support level. So I would strictly watch XAU to USD, because we still have a chance to reach this low 1796 levels, within which I would reconsider having a short position with a possible of an extension for this trade to even down of 1687 with risk-reward ratio at a very lucrative level at around 7. That's why I do find that tracking for what the performance of XAU USD in a few next days or hours is very important. That's why I would set an alarm right below those highs of 14th of August, and right at around 1796 I would reconsider this to make a short bet. You may make a short from somewhere between those boundaries marked by this blue transparent box, whereas the highest side is attached to 1800s around. So XUSD right now is also one that is favoring by non-commercials, large speculators, but that already happened, and we may find that smaller speculators is right now smaller speculators are reverting of the market. That's why with this rebound we may find another stop will be right around low 1700s. Okay, so that's it in today's episode. Thank you very much for watching, and as every time, if you have questions, just put it in the comment section below the video, and see you tomorrow.